If you're interested in real estate investing but not sure how to choose the right investment property, this video is for you. Today, I'll be sharing the essential factors to consider when selecting a property to add to your investment portfolio. Investing in real estate can provide opportunities for financial growth and generating passive income, but it's critical to choose properties that align with your investment goals. In this video, you'll learn what to look for when evaluating potential investment properties, giving you the tools to make informed investment decisions. Imagine having the confidence to evaluate properties and make informed investment decisions that maximize your return on investment. By mastering the process of choosing the right investment property, you'll be one step closer to achieving your financial goals and building a successful real estate portfolio. Get ready to take notes as I walk you through the key factors to consider when choosing the right investment property. Whether you're a seasoned real estate investor or just starting, this video will give you actionable insights to help you build a successful portfolio. Let's dive in. 1. Location. When considering an investment property, it's important to take into account the context in which it's situated. A beautiful vacation home may not attract many visitors if it's located in an area that's not a popular tourist destination. Similarly, a fixer-upper may be a smart investment in a competitive housing market like the Bay Area, where renovation costs can be easily recouped, but may not be a wise choice in a less competitive market. Always prioritize location over the property itself. While it may seem counterintuitive since you're buying the physical structure, a property that's in the wrong location is unlikely to be a good investment. After all, the right property in the wrong location is not likely to be the right property for you. 2. Down payment differences. When purchasing an investment property, the down payment requirements are typically higher than those for a standard family home. While a down payment of 1% to 10% might suffice for a family home, you typically need to put down at least 15% to 20% for an investment property. Mortgage insurance is not available for investment properties, and the stricter financing approval requirements make a more substantial down payment necessary. The amount required for your down payment will depend on factors such as your credit score, income, and debt-to-income ratio. It's important to sort out the details of your financing before beginning your property search so that you can determine what's feasible and what isn't, just as with any real estate purchase. 3. The 1% rule. When evaluating the profitability of an investment property, it's essential to apply the 1% rule. This rule of thumb, commonly used by real estate investors, states that you should aim to generate a monthly income of at least 1% of the total investment, including the purchase price and any additional costs like repairs or renovations. For instance, if you invested $250,000 including a $225,000 purchase price and $25,000 in renovations, you should aim to receive a minimum of $2,500 per month in rent or other returns. However, there are exceptions to the rule. If you're purchasing a $1 million property or buying in an emerging neighborhood with low initial returns, you may choose to focus on long-term gains instead of adhering to the 1% rule. In such cases, you should aim to keep your monthly mortgage payment at 1% or less of your investment to avoid losing money. To estimate your annual return and determine the profitability of your investment property, use an investment property calculator that accounts for financing and expenses. This will help you make an informed decision about the viability of the property as an investment. 4. Fixes and variable expenses. Owning an investment property is a long-term commitment that requires financial planning beyond the initial purchase. The key to staying profitable is to account for both fixed and variable expenses that come with property ownership. Fixed expenses are regular, predictable expenses that are necessary to maintain your property, including property taxes, homeowners insurance, property management expenses, and general upkeep costs such as cleaning and landscaping. Variable expenses, on the other hand, are unexpected and harder to anticipate. These can include repair costs for unexpected issues like a damaged roof or a malfunctioning water heater. It's important to budget for these variable expenses to ensure you won't end up in the red. By budgeting for both fixed and variable expenses, you can ensure that you're financially prepared for the costs associated with owning an investment property. This will help you stay profitable and ensure that you're able to continue investing in real estate for years to come. 5. Property management. When it comes to managing your investment property, you have two options: hands-on management or hiring a property management service. If you're the type of investor who wants to be involved in the day-to-day operations and deal directly with renters, being a landlord might be the right choice for you. On the other hand, if you prefer to take a more hands-off approach, a property management service can handle everything from finding tenants to handling maintenance requests. It's important to note that while hiring a property management service comes with a cost, it's not necessarily more expensive than self-management. It could even be more cost-effective, especially for vacation rentals. Marketing and booking fees can add up quickly when advertising a property on various websites, whereas a property management company may only charge a commission fee of around 10% per rental. Research both options and weigh the pros and cons before making a decision. Don't forget to factor in these expenses when evaluating whether a particular property is a good investment. 6. Know the risks. When it comes to real estate investment, there are inherent risks that you need to consider before making any purchases. It's important to be aware of these risks and prepare accordingly. Some of the most significant risks to keep in mind include: uncertainty in rental demand, unforeseen expensive repairs, potential increase in property taxes, changes in the local market economy, the possibility of bad tenants resulting in repair costs or eviction expenses. It's crucial to not solely focus on the risks, but also not to ignore them. No investment is guaranteed, but you can mitigate the risk by being prepared financially and seeking advice from experienced advisors. An investment property can be an excellent purchase, but you should ensure that it's a smart one by thoroughly evaluating all of the factors involved. Don't hesitate to seek help from professionals to navigate the process and make the best decision possible. Thank you for watching our video on how to choose the right investment property. We hope you found it informative and helpful in your journey to becoming a successful real estate investor. If you enjoyed this video, please consider subscribing to our channel for more content on real estate investments. We regularly post new videos with tips, advice, and insights to help you navigate the world of real estate investing. We also value your feedback and suggestions, so please leave a comment below to let us know what you thought of this video and what other topics you'd like us to cover in the future. Your input helps us create better content that meets your needs and interests. Thank you again for watching, and we look forward to seeing you in our next video.